Hello everyone and welcome. Thanks for joining me. Now today I'm going to go through 3 stocks that I believe are potential buys. Just remember this isn't official financial advice, so make your own decisions and do your own research before committing to act. So let's have a look at the 3 stocks, and just a sneak preview for you, I may have bought at least one of these this week. So we're going to start off with Walgreens. Now, first of all, you're looking at a trailing P of 18, which isn't particularly remarkable, it's pretty average, but the forward P here is just 9. And further to that, the dividend is around about 4%. So that's quite attractive. So if you're thinking a 4% yield and there's some improvement coming, then that's a very positive thing. Now, if we have a look at what's expected over the coming years, they're only saying a 5% per year growth rate in earnings, but I think that is very much an underestimate. They're effectively getting additional foot traffic into many of their stores where many millions of people are getting their COVID vaccinations in the US. This is effectively zero cost of increasing footfall, so that's a very positive thing. They've got a good leader in now who's got some great experience and has worked at Amazon before. I'm not too concerned about their debt because the vast majority of it's very long term, and they're about to pay some of their facilities down the sale of one of their, a large part of one of their subsidiary companies. So we look at this one and I see free cash flow around about $5 billion. And the reason I'm pretty excited about that, have a look at the market cap here. The market cap is 41 billion. So the free cash flow is over 10% of the value of the market cap of the business. It's a very significant ratio. And if you have a look at the earnings situation, you can see here there have been some dramatic beats that have come in recently, and they've got better and better each quarter. I think they're very much being underestimated. They're outperforming analysts' expectations. Dividend is good. Management is improving and now good. Debt isn't much of a problem in my opinion. And that forward P looks very, very tasty. Now, a quick look at Simply Wall Street has a different opinion. Now, they think earnings are forecast to grow at 23% a year, and they've got fair value at 126. I can definitely see where that comes from. So that is stock number 1. It is something that's already in my portfolio for full disclosure. And if you're interested in my portfolio, I do a series every month or so where I go through the performance of am I on track for my £1 million investment challenge. And then a few days ago I did a video on how each of my individual UK holdings are performing, position by position, and coming up in the next couple of days is the same for the US holdings. Alright, number 2 is Discovery. So this is a bit of a new one for me. But again, we've got a situation here with a company with a forward PE of 9. We've just started a subscription service, kind of competitor to Netflix, to Prime, to Disney Plus, etc. Obviously a very different topic area. And they've gone from 0 to 15 million direct to consumer sort of paid subscribers in 4 months. That's really outstanding growth. That brings them much better margins than they do kind of selling their content to other networks, and they actually own most of their content, which is quite unusual. If we look at some of the analyst views, you've got growth of over 10% a year for the next 5 years, which looks very interesting. You'll notice there's been a bit of price action here, and there is a merger that's going through. And what you can see with the merger is from the AT&T website, you've got Warner Media and Discovery, and they'll merge with a standalone company. And I think Discovery gets 29% of the new company. That's a decent deal for Discovery. And with the content that will come from them and from the HBO thing, kind of got a good sort of family collection there. And again, we have a look at Simply Wall Street. For a bit of an estimate, they're suggesting 72% undervalued. They've got earnings coming up at 18% a year for the next 3 years. So overall, this one looks reasonably interesting. I think it needs a bit more research before I potentially buy it, but it's certainly one that I think looks like it's good value, particularly now that the hype has died down. Have a look at just the long-term view. You can see the company's been growing revenue nicely. free cash flow is decent level there. You've got 2.3 billion. Market cap is 15 billion. Again, proportionally, that's a very good amount of free cash flow compared to their market cap. So for me, anything above 10% is looks like quite an interesting buy. Okay, number three. Number three is Intel. So the thing with Intel is, I think, as far as rule one of investing very well, which in the long term, I don't think you can lose money on Intel. It's just going to steadily grow away, and you can see its history here over 10 years. It just sort of chips away bit by bit each year. Now it does do most of its own manufacturing, and that's why there's a lot of capex spending. It does still produce a lot of free cash flow in the 20 billion or so range. Market cap is 227 billion. You're not too far off that 10% there, and you've got a PE of 12 and a forward PE of 12. So these are pretty low numbers in what you could say is an overvalued market. If you look at what Intel does, the total addressable market is always going to be growing. And I think the things that they do is not something that's going to go out of fashion per se. I've got a view here for Intel from Yahoo of 5% a year for the next 5 years. Valuation, simply Wall Street thinks they're fairly valued at the moment. I don't agree with that. I think based on the free cash flow they generate, and if they chip away at 5% a year, they're certainly 30 to 40% undervalued in my view. I think there is a bit of upside there, and I think they do pay a decent dividend. I think it's about 2.5%. With those PEs, particularly compared to some of their competitors, and if you think about the margins Intel commands, well into the 20% for most years, it's a very compelling investment as an overall company. They're not perhaps having the best year or two in terms of their product development, and they have been beaten by some of their competitors in terms of speed for certain next generation chips. But I think those are short-term things. I think the long-term Intel is still a very, very strong company, produces very good cash flows, very good margins, and it's pretty cheap. It's trading lower than your market average PE, and it's trading lower than the overall market PE by a decent distance. It's a very strong company, and I don't think you can lose money on it. So that is stock to buy number 3. Finally, if you'd like to know when I buy or sell stocks, including what I have bought and sold this week, please do consider joining me on the Patreon site. Shout out to my VIP patron. So thank you for joining me on this one, and I look forward to seeing you on the next one.